What's up, everyone? It's Caddy with Money Vesting. So I spent the last, quite a few hours kind of listening to Ray Dalio, rewatching his, famous 43-minute clip on the principles for dealing with the changing world order, and also reading the monthly newsletter that was released last week on what Ray Dalio actually thinks about the current Silicon Valley Bank situation. So I figured I'd do a video, talk a little bit about it. I also broke it down in my other video going over, a very, very short clip and where we learned about what Ray Dalio really believes is the more immediate problem. But in this video, I wanted to kind of build on that and expand it a little bit further and also go over why Ray Dalio believes that the next 2 years will be, quote, very risky at the moment. So hope you guys enjoy this video. Find it helpful. If you do, make sure that you drop a like, subscribe to the channel if you're just joining us for the first time. A link to our Discord and Patreon is going to be down below. I will see if I can share that newsletter, the link in our Discord if anybody wants to read. It is quite long, but I'm going to try to summarize it the best I can in this video. So the title of that newsletter, monthly newsletter that comes out every month, of course, is what I think about that Silicon Valley Bank situation. So in the other clip that I posted, in my other video, he mentions that this is a very, very classic case or event that happens in very classic bubble bursting part of the short-term debt cycle, which lasts about 7 years, give or take about 3 years, in which the tight money is created to curtail credit growth, and inflation leads to self-enforcing debt credit contraction that take place via dominoes falling, like contagion process that continues until central banks create easy money that negates the debt credit contraction. So what he's really talking about in that, expert over here is just the idea that the Federal Reserve is going to, at some point, the Federal Reserve is going to flip, right? It's going to flip its course. And because of the tightening in the economy, because of the credit crunch, because of the liquidity crisis, they're going to pull back on all this quantitative tightening, which he also talks about later in this newsletter. And another thing to point out here is that Ray Dalio, of course, is a global macroeconomic investor, right? He just doesn't look at one particular set of data points or doesn't look at one particular economy, but of course, he's really good in connecting the dots when it comes to looking at it from a more broader perspective, from a macroeconomic perspective. So, when it comes to these cycles, he's kind of listed them out into short-term debt cycles and long-term debt cycles. So short-term debt cycles, he's mentioned that they last about 7 to 10 years, give or take 3 years. And the long-term debt cycles, they last 75 years on average, give or take 10 to 25 years. So moving forward in that newsletter, he talks about, of course, how the machine works, right? One person's assets are another person's liabilities. One person's debt is another person's assets. And the most people are levered long. This is also something that we heard from his more recent video, that they're holding assets financed by debt, right? A lot of people, a lot of investors, institutions, they're holding on to assets on the long side. They're betting that prices are going to go up, and they are levered up, right? They're using margin to do that. When interest rates rise and the money becomes tight, assets fall in value, which hurts debtors, creditors, asset holders, and financial intermediaries, which causes a self-reinforcing contraction and a contagion, because when money is needed, other assets are sold. So when money is needed, when there's a liquidity crisis, investors or intermediaries or asset holders, they sell those assets in order to create that money, to get access to that money, and that creates even more selling pressure, which of course, creates this curtail in lending and of course contraction in the economy. And those financial intermediaries, most importantly banks, that are the most levered long to the asset bubble that is bursting, are particularly affected as well. It is a classic that is coming out of an extended period of very, very low interest rates and abundant credit. That is enormous amount of leverage, long holdings of assets that are going down due to higher interest rates and tighter money, which is producing this classic dynamic of dominoes falling. So in other words, what he's really saying is that because the interest rates were so low for such a long time, everyone was borrowing at a low cost. They were levered long. In other words, they are investing long, expecting asset prices to keep going higher. And as interest rates keep going up now, as we are seeing a very aggressive Fed policy, as interest rates are higher, cost of borrowing is higher, we are seeing prices come down. And this is also putting a lot of intermediaries, financial institutions, underwater. Now, he says that because we are in the early stages of the contraction phase in this debt cycle, the amount of leveraged long holding of assets is large, it is likely that this bank failure will be followed by many more problems before the contraction phase of the cycle runs its course. Before the contraction phase of the cycle ends, history and logic have shown that there will be 5 things. Number 1, forced sale of assets at very low prices that require big losses. So we've already seen that. Silicon Valley Bank already did that. Number 2, equity dilution, selling at prices that are significantly discounts the conservative estimates of present value of all future cash flows. We've already seen that. I mean, Silicon Valley even sold to First Citizen Bank, and of course, a lot of other banks. Credit Suisse being sold to Deutsche Bank. Number 3, attractive acquisition prices for strong synergistic companies to buy distressed ones. And number 4, credit problems being a negative for markets and the economy. So because of this credit crunch, because of liquidity issues being a negative for the economy and the markets. And number 5, eventually the Fed easing and bank regulators providing money, credit, and guarantees because the problem becomes a system threatening. And we also saw that as well with the Federal Reserve pumping its balance sheet once again and the Treasury Department guaranteeing deposits. Of course, Janet Yellen kind of backpedaled that a little bit, but for the most part, FDIC is there, the Treasury Department is there, and the Federal Reserve is there. At this turning point into the contraction, Ray Dalio says it is too early for the Federal Reserve to ease, but he says, I will be watching closely at what they actually end up doing, and the trade-offs obviously become more and more difficult and more tough. Because on one hand, you've got high inflation. On the other hand, you've got a weakening economy. That's the trade-off. And that's, we have talked about this on the channel, is a dual mandate. And where is the worst place for the Federal Reserve? It's an environment with high inflation and high unemployment, right? That's going to be a tough trade-off for the Federal Reserve. And looking backward rather than ahead, tightening rather than easing seems appropriate. Looking ahead, it's likely that it won't be long before the problems pick up, which will eventually lead the Fed and the bank regulators to act in a protective way. So he says, so I think the Fed and the bank regulators to act in a protective way. So I think we are approaching the turning point from the strong tightening phase into the contraction phase of the short-term credit and debt cycle. Now, that was all short-term, right? That was all related to what the Federal Reserve is going to do, which is, at some point, there's going to be more cracks in the economy. There's going to be much bigger problems. It's not going to be contained within just a few banks. And as the credit becomes more of an issue, liquidity becomes more of an issue, the Federal Reserve is going to pull back. There is going to be support, extra credit and money and supply from Treasury Department and the FDIC and the Federal Reserve as well. That's a more short-term problem and a solution. Now, so he talks about, let's look beyond the immediate problem to what I believe will eventually be the much bigger, longer-term problem, he mentions in his newsletter. And he asks this question, how do these cycles actually go? When debts are in a country's own currency, which is what the US is right now, all the debt is pretty much denominated in US dollars, it's an own currency. Debt crises and the debt contagions that result from them can will eventually be contained by central banks, creating enough money and credit to fill in the funding gaps. For example, in the case of the Fed guaranteeing all depositors against losses and indicating that it will go beyond to protect others, not only did it come up with more credit, but it also signaled that it would probably act similarly in other cases. So in that statement, what Ray Dalio is talking about is the fact that the Federal Reserve is pretty much telling you that we are ready to protect all depositors any way possible. We're going to use our tools to protect depositors. And then he asked the question, that begs the question, at what cost is money and credit being created, right? All this money printing that we're seeing, at what cost is this being created, right? And that cost, unfortunately, is going to be inflation. And I'm not gonna go into too much detail here, but the bottom line is, if there's consistent money printing, if there's constantly the money printer being printed, and there's a lot of QE that's happening in the background, what ends up happening is you'll have a lot of dollars in circulation chasing too few goods and services, right? You will have a lot of money, right, on hand chasing little to too few goods and services. What happens in that scenario when the demand's too high, supply is too low? That is an inflationary scenario. We learned what happened back, in 2021, 2022 when QE went on for too long. That resulted in a 40-year high inflation. And right now, we're kind of starting to see some hints of that play out again. I mean, the Fed's balance sheet exploded $400 billion. We've already seen a lot of bridge banks and a lot of individual banks kind of taking on a lot of borrowings once again. So that obviously becomes a much bigger problem. So Ray Dalio says that brings us to a much bigger, longer term problem, which is that the US central government has large outstanding debts and is selling even more debt than there is demand for. And central banks are monetizing that debt. Controlling the problems is financed by central banks printing money and buying the debt. With debt assets and debt liabilities so large, it is very difficult to keep real interest rates high enough for the lender creditors without making them too high for the borrower debtors. So what he's really saying is that whoever you're selling this debt to also needs to make a real return, right? If they're not making a real return, they're not going to hold on to it, right? And the only way they make a real return is the interest paid on that debt is higher than inflation. If inflation's higher than the interest paid, then there is a negative real return on those debt assets, right? It's pretty much useless to the person holding on to these debt assets. So the real big problem will come when there is too much of this money printing, Ray Dalio says in that newsletter, to provide creditors with adequate real returns, which will lead them to start selling their debt assets. Again, if it's worthless to somebody holding a debt asset or US bond, because they're not even able to generate a real return, what are they going to do? They're going to start selling, right? And this will substantially worsen the supply-demand imbalance with the enormous size of U.S. debt assets and liabilities outstanding, plus lots more to come. There is high risk that the supply of government debt will be much larger than there is demand for it, because as more and more holders of U.S. bonds start selling them, supply starts to pretty much be in abundance, prices go down, yields start to go up. In which he mentioned, which will cause too high real interest rates for the markets and the economy, leading to a debt and economic pain that will eventually lead the Federal Reserve to switch from raising interest rates and selling debt, which is what they are doing right now, to lowering interest rates and buying debt once again, which is going to be part of QE. And this will lead real rates to fall, which lowering interest rates and buying debt obviously does. And that will lead to a high risk that there will be more selling of debt assets because of the bad real returns that these debt assets are providing. So again, I mentioned this very briefly in my other video, right? This is a very, very psychological nightmare sort of like cycle where the US never wants to be in or never should be in, because that would be obviously super catastrophic for the economy. And this is a bit of a blind spot. I feel like I think we need to talk about it more. It's not being addressed enough. And something that, Ray Dalio is putting it out there, right, in his research and talking about it in his newsletter as well. Now, he also talks a little bit about the next 2 years. So he mentions that I think there is a good chance that it will produce a big decline in value of money. So it looks likely to me that the financial economic picture over the next 2 years will be tough. And he also mentions towards the end that it looks to me the next 2 years will be a very risky time for the markets and for the economy, because again, he's kind of putting that all together with the three things that he focuses on: bad financial and economic conditions, bad internal conflicts, and he ties that in with the 2024 US elections. And then he also talks about bad international or external conflicts with US-China conflict and the US-NATO-Russia conflict that's going on as well. And that is what's going to devalue the currency quite substantially. And again, I've actually spent a lot of time kind of studying, these things from a more macroeconomic standpoint. Watch Ray Dalio's video, watch another one refuting Ray Dalio's, consensus of, the global reserve currency, of this decline of the U.S. as a superpower and China on the rise. There was very, very good points put together. So I'm definitely going to be building on this. We'll be doing more research, but let me know your thoughts. Like I said in my previous videos, it's going to be a little bit more gravitated towards more physical assets as well. Real estate and gold are going to be at the top of the list. And when it comes to equities, only looking at high quality companies, really just not going after any speculative companies that are trading on, that are very sensitive to interest rates. Not going to be for me. And we'll be looking at emerging markets as well. So India is one place that I've already mentioned at the beginning of this year that I think there's a lot of potential here for growth over the next 10 years. So we'll be doing, again, this is going to be something that we build on, right? It's not going to happen overnight, and something that I'm going to consistently provide you guys updates with and share my thoughts and my views on where I stand with the current portfolio allocation. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like, subscribe to the channel. If you're just joining us for the first time, link to our Discord and Patreon is going to be down below. So always happy investing. I'll see you all in the next video.